Hello and welcome to Jim Dalton's presentation on how to prepare for the open and the first hour trade. It's September 3rd, 2014, currently 9:16 a.m. Eastern. We'll go for the first hour trade about 10:30 a.m. We'll get to as many questions as we can, but please, if you don't get the answer you need, please come back to us in email or phone. And thank you everyone for being here. We have a full house and it's great to see you all, so thanks for taking time out from your busy day to be a part of this. You should have seen a note that there is a report or two reports for this morning's presentation to supplement Jim's discussion. So if you haven't seen those reports, please go to our blog. There's an S&P morning report that was published about 10 minutes till 9 a.m. Eastern, and there was a recap and preparation report that was distributed to intensive traders last evening. So please have those up, so that'll help you with this material. And with that, I will introduce Mr. Jim Dalton.
Well, hello, good morning. I must admit I'm only back reluctantly. I've been fishing for steelhead in the Pacific Northwest on the Washington Peninsula, and it's the only time I went a couple of days without even looking at a watch because I really didn't care. But anyhow, we are back and ready to go to work. The first slide, how to prepare for the open and first hour of trade. This is just a huge issue. So many people don't really know, or if they do prepare correctly, once price opens or once the market opens, they tend to forget what they prepared for. When I prepare, and you'll see it in the reports that you got, I look at the monthly, I look at the monthly bar, and it's not too necessary right now because we know all the markets or all the S&Ps are at the highs. But I look at the monthly S&P, and when I look at that, it's to give me a perspective. Are we trending or are we balancing? If we are balancing, what's our trade location within the balancing range? If I'm trending, I try and make some idea, am I early or late in that trend? Lateness in the trend starts to show that the different balance areas are starting to overlap, and the last month's range would have taken out, or this month's low would have taken out last month's low. There's things like that, indications. Okay, once I leave the monthly, I then go to the weekly. And if you look at the current weekly report you got, the weekly is the first report that really caught my attention and is more revealing. The last week's low, if you will see, wasn't too far from yesterday's low. I think there's only 4 or 5 handles. So any meaningful correction that gets under the way this week would take out last week's low. So I'm going to take last week's low and I'm going to put that on my daily charts. I want to make sure I know where that level is. And what you'll see sometimes, if a market starts to break, you'll be very helpful because you will find it is moving towards some of these references. So once I look at the monthly, I look at the weekly, and like I say, this week, when I looked at the weekly, I said, okay, I see last week's low as a fairly important reference level. I believe that was right around the 1988 level. Then I look at the daily, and I see if the daily gives me any additional information. The daily this week provided me about the same information as the weekly. Then I go to the profiles, and when I look at the profiles, that's really where I start to hone in on it very closely. It's like putting the markets under a magnifying glass. Once I have the profiles in mind, and I start to see things like important, prominent points of control or very prominent points of control that have not been revisited. A point of control is the longest line reading from the left to right on the profile. The wider that line is that hasn't been revisited, the more likely we are to go back down and review that area sometime in the future. Maybe it's today or tomorrow. So I get a perspective, I'm ready, I get a perspective of overall where the market is trading. Am I trending? Am I balancing? Etc. Then, and I'm looking to see what went on yesterday. For example, yesterday's profile shows you that we did not have a good high yesterday. In other words, there was no single print selling tail on the top of yesterday's profile. That very often is an indication that we will come back to and through that area. So once I've done that, the next thing I do is
Jim,
I look and see. Yes.
Can you put up the report or go to our blog? It's on the blog, so people can be following along with what you're saying.
Okay, can you put it up on yours? Is that faster?
Sure. I guess I'll use the recap report first. Okay. Can you see it?
Yes, I can. So you'll see there's the monthly, and the first thing when I look at the monthly, I notice that the all-time high was made in the electronic market, and we know from past experience that is a very rare occurrence when the all-time high occurs, a lasting all-time high or low occurs in the electronic market. Yesterday, it left that high in the electronic market, came back this morning and or in the overnight last night and took it out. Okay, so let's go to the weekly. And you'll see on the weekly, I actually have a combined report, combined reference down there. I have last week's low, and then I have a prior trading range high at the 1985.50 level. So I look at that, a prior trading range high and last week's low. That combined reference, it goes for a couple of handles in there. But if there's anything major going to happen and change, we will get it down below and start to trade below that level. Right now, that isn't relevant because the market's trading quite a bit higher. But if the market should start to break, that's where my focus will immediately go and say, okay, anything major, I'm going to start to challenge that combined reference down there. Okay, and then I go, and I've got that, and then I go and I look at the daily. And the daily gives me, you see those same two references, the 1896.50 level as well as the 1908.10 level. You see that they're basically the same. And so you don't see anything different. It's just another way to look at it. Okay, and once I have that perspective, I go to the profiles. And the profile changed my references just a little bit. I had a 2-day high, and I look and I say, okay, a 2-day balance. And I look at that 2-day balance, and I look at the low, and the lows are pretty close to each other. But I say, okay, if there's anything meaningful on the downside, I'm going to start to trade down below that 2-day balance. Then I look on the 2-day high, and I see that yesterday's high makes up that 2-day high. And while it was a new pit session high, it was not a new high on the electronic market. And you'll see that the all-time electronic market is still marked up there at 2006.25. So, you going to say something, Julia?
Yeah, we have 5 minutes, so I don't want to take too much time, but a gentleman's asking if don't we have a 6-day balance, but clearly that excess low down there, drawing balance areas is more an art. But
it's an art. What I see on a short-term basis, I saw a 2-day high. That doesn't mean that I'm correct, but that's what I saw based on my experience of what I thought was going to be more important. Because if you take the 6-day high, you've got to get way down in this level where you see the excess low reference.
98 quarter, yep.
For that to happen, you've got to take out the 2-day low first for this to get challenged. So,
Okay.
and if you come back in the 2-day high, you're going to also be back in what you call the 6-day high. So this is a more of an art than a science. But I saw this as my short-term reference this morning. Okay, so when I come in,
we have 4 minutes, Jim.
My focus is on the 2-day high and low. Next, I go and I look and I say, okay, and let me bring up my screen. If I could have the control back.
You got it. And also, here you go, Jim. Also, though Jim uses real-time trading hours, pit session hours on the bar chart, so he can see gaps and the pit sessions only. So that, thank you for asking.
Okay. Now,
it's off of the slideshow. Okay. There we go. Great.
Now I go and I look. The next thing I do, I say, okay, let's look at the overnight market. The first thing I focus on is yesterday's settle at 1999.75. And I look at that and I see that almost all of the trade, all but a couple of ticks, of trade took place above last night's settle. That means that my inventory my overnight inventory is what we call 100% long. When it's 100% long, that's important. All I look at is the overnight inventory long, short, and if it's took place above the settle, then it's long, long, short, or balanced, and I look at the overnight high and low. I do not look at the shape of the overnight profile. And the reason for that is there's usually not enough volume to make it, to give it the validity. You don't have a large enough sample size of trading to make it relevant. So once I have the overnight inventory up, then I can see where we're going to open, and we're 2 minutes before the opening. So I say, okay, I'm going to open out of balance relative to yesterday. And if I open within the center of yesterday's range, then I sit back and relax a little bit because I say it's probably going to be a slow start. I'll give the market a chance to kind of shake out. When I open out of balance, those are usually the biggest opportunities. So I may have to trade early. And when it opens out of balance, it's either a big day up or, the market fails and you get a pretty good trade to the downside. So right now, we will gap, as of right now, with a minute to go, we will gap higher. Gap trading rules are in play.
Can you mark the high of the pit, Jim? That's how you measure a gap, not from the settle, so there's no confusion.
Okay. The gap is from 204.25 to the overnight high. I don't know how I got
No, don't close that. The red X, Jim. The red X. No, no. That one right there.
Okay. Okay, so now I know I'm going to open out of balance in just a couple seconds. When I open out of balance, the ideal long is an attempt to fill the gap that fails just above the 204.25 level. That's the ideal long. Okay, so now we're open. We're open out of balance to the upside.
Can you make it just a little bigger, Jim, so we can see? Not too big. Okay. So I want to see all the overnight.
Okay.
Definitely.
So I'm out of balance to the upside. So I'm watching to see if I'm going to be able to fill that gap. Now we do have some reports coming out this morning. Okay. Let me see.
I can tell you. Okay.
The biggest report this morning is going to be the beige report, the beige book that comes out after the market 2 o'clock in this afternoon. Let me look and see.
We have, I can tell you, Jim, it's factory
Okay.
orders at 10 a.m. We did have ADP at 8:15.
No,
Is-
ADP I think comes out tomorrow. I
Oh,
think they've delayed it.
no,
I think,
it's today. It's today. It came out at 8:15 a.m. So we have
which,
Red Book
are you,
came out at
I,
8:55.
okay, I didn't get any numbers for ADP.
Okay, well,
I thought
it
this
always
report
comes out
had
on a
come out.
Wednesday before the monthly employment number. Oh, released on 9/4.
Yeah, it's
Okay,
I think
okay,
it's tomorrow.
okay.
I think it's tomorrow this
All
time.
right, but we have factory orders at 10. It's the next report.
Okay. Now, here's something that I say all the time, and it's very rare that somebody abides by this. Do not look at the report. All you want to know is the time the report is coming out. Had you looked at the reports yesterday, they were both very bullish reports. One of the reports was, at the highest it's ever been, or the highest it's been in many, many years. And what did the market do yesterday? The market went down early in the morning. What happens, cognitive dissonance is, one of the most dangerous things for traders. You look at those numbers and they're very bullish. It makes it very hard sometimes to go with the short side of the market when they're bullish. And yesterday the market was clearly down in the morning. And if you looked at those numbers, it would have made it very hard for you to do the correct trade. So my recommendation is know what time the number is coming, and then read the market, how the market reacts to it, rather than try and interpret the number yourself and what that number means, because you don't know what the market's already got built into it, or what's anticipated. You don't know the changes, what was anticipated. So I know the only people that come and thank me for that are people that are experienced traders, really experienced traders, and they will tell you that they learned that from me and they do not look anymore, and they find it very helpful. But it's almost impossible not to look at those numbers or listen to them and think that you can interpret those numbers and know how the market's going to react to it. Okay, so we looked this morning. So far, we are out of balance to the upside. The market, it's a very narrow range. We have not taken out the overnight high or the overnight low, and I don't see anything. I don't know any trade that I would do right in here so far. One of the things that you're going to find is that, and we'll show you, we've used them advertising for the intensive we've got coming up here in a few weeks, but they're unsolicited comments or testimonials we got from traders. And one of the things really has to do with the maturity of a trader. And the maturity of a trader is being able to pass on a trade when it just isn't clear what the market's going to do in there. And so many times traders early in the morning, they're so anxious to trade, they're so afraid if they don't trade in the first few minutes, they're going to miss the biggest trade of the day. And that's a very difficult time to trade. You get a lot of chop in that period. Okay, we'll come back to that. But right now, the market's attempting to go lower. It's attempting to fill the gap. So the overnight inventory is 100% long. We are showing about 65% of the time there's a counter auction to the overnight inventory. And that doesn't mean it has to take it out 100%, but about 65% of the time there will be some counter auction or rebalancing of that overnight inventory. And even if you don't get the counterbalance, sometimes if the overnight inventory is long like it is today, it will restrict further upside movement for some period of time, just simply because there's profit taking from those that are long from overnight. Overnight longs or overnight shorts tend to be relatively weak longs or shorts. The really large, more sophisticated traders very often don't trade overnight. And the reason for that is they can't get the volume and the liquidity that they're looking for. What do I mean by liquidity? If they had a large order to buy or sell in the overnight market, they'll get their prices spread out. They'll get some at 207, 207 and a quarter, a half, 3/4. I mean, and they're not accustomed to that. They're not accustomed to having their prices strung out over a couple of handles. But that's what can happen in a thin overnight market. Okay, so far we have the gap is holding. The gap is holding. We have a very narrow range, and we've got two more numbers that are due out in a little while, and we have overnight inventory being 100% long. I see nothing to do so far. Okay, Julia, questions while we're looking at this?
Yes, Jim. How long do you wait for the value assessment to form? If the gap is filled and value cannot at least become, similar to value for the prior pit session, how long do you wait to make that assessment?
It's not a time issue. It's a combination. You'll see how much confidence there is as the market's trading lower. What Julia is referring to, the gap trading rules say, okay, if the gap is filled, but value doesn't at least become unchanged or overlapping yesterday, then the odds are really high that we will have a later rally. And the reason for that is that value will be higher, and we trade value, not price. So the question is, well, how long do you wait? Well, it's a combination of, if the market's going down and you've got high confidence, then you're not going to wait as long because, okay, I got high confidence, the market's one time framing lower, I'm getting good volume, the odds are pretty good, I'm going to get that value. So, but if the market goes down, it fills the gap and it just stalls and there's not much downside continuation, then you say, well, it's a pretty good indication we're not going to get overlapping value. So it's not a singular answer, it is a combination answer, and you look and see how much confidence there is, how much volume, and is there really a good, strong directional tone.
Okay, great. Thank you, Jim. And you're always carrying forward the confidence in the tempo, and clearly we have a low confidence open. There's no directional conviction as of yet. So you're thinking of that as you're looking at the gap being filled and that sort of thing. Is that correct, sir? Or is it just shakeout in the morning and you don't want to make that call just yet?
Yeah, I don't, so far the pressure's been on the downside. But there's certainly, people could have come in and sold this market aggressively at all-time highs. And, the highest that you could have ever sold. And nobody has come in and said, well, let's do that. It looks to me, what I see so far is we're pressuring the overnight inventory. That's what's happening right now. The overnight longs are getting pressured. And as we say, that happens about 65% of the time that that goes on. And that's what I see happening right here. If you had a combination of really good, strong selling in here, you wouldn't wait this long. They'd be selling right off the opening bell. So right now you're getting, I think you're getting some liquidation of overnight inventory. They're trying to close the gap. Everybody knows where that is. Remember, the closing the gap also puts you back within the two-day high. And then that would be the chances for a more significant run on the downside. Okay. So right now, if you're looking, for example, everybody's got a different method of trading. But let's say you wanted to go long. When this market trades right down where it is now, someplace, you can go long. If you want to go with the gap, go with the direction, you could have bought this market right here, and you stop someplace down below the filling of the gap. Like I say, everybody's got their own way of trading the market. If you were looking to go with this gap on that last little break down there, you had an opportunity. You could have bought there with the stop if the gap is filled. I mean, I'm not saying I would do that trade, but I'm saying that everybody out there is different, and a lot of times what I'm looking for a place where I can put a trade on, and I have a structural place to place a stop. And the structural place was if I do fill the gap. Okay, and when you're looking at this, the reason that comes to my mind, here's the opening. We've been trading lower, but value's clearly building higher. There's no real volume on the sell side. The heaviest volume's up here. You know, we got light volume down here. So there's no, and we're back to the halfway mark is the white line. There's just no real conviction going on in this market today. The market is higher. The market is higher, clearly higher. We've gapped higher. There is no indication at this point in time that there's anyone really aggressively waiting to take advantage of selling at all-time highs. Okay, questions?
Thank you, Jim. Yes, we've had a question about the value area high and the value area low and the point of control from yesterday. Basically, you can see it on that profile to the left of the overnight profile. That's the value area high. We'll make the value areas a little brighter on Jim's screen for the next webinar, but that's the value area high, and the value area low is indicated at the 96.75. The green line, left to right, point of control, is at 98.75. Okay.
And I pay no attention to that today because it's not prominent, and I want to know where the value area highs and lows are. I am not a purist where I'm saying I'm looking exactly for the value area high or low. My perspective is a little bit broader than the exactness of that high or low. I want to say overall, what do I think is going to happen?
Okay, great. Thank you, Jim. And this is an example too where early in the morning, it's our experience working with traders that they can get chopped up in a market like this, trying to take advantage when the market really hasn't made a decision. So what we've seen in the intensives and just working with Jim, that there's a certain steady hand at the wheel, that we don't have to be over eager. And like Jim said, and there is a slide on this, being mature as a trader, you've hit trader maturity or trading maturity when you can look at a trade and pass and wait for something ideal to your particular setup or trade. So that's it.
And you know you don't have that maturity if you're sitting here staring hard at this market. So do I want to go long or do I want to go low? You know, when you're feeling that impulse, I got to make a trade. I got to make a trade. What am I going to do? Am I going to go long? When you feel that, you're working more on impulse, and when you're working on impulse, the chances are you're not going to make the right decision. That maturity to say, yes, it's gapped higher and everything else, but there's really no conviction around here. I'm just going to sit it out. I got plenty of time. There'll always be good trades. That is the maturity that you are looking for in here. But if you're feeling over anxious to make a trade right now and be involved in this market, then that's a difficult situation because your emotions are too high. Okay, here we go one more time. They're testing the low, and notice the low went exactly the halfback in the overnight market, which again, when I see that kind of thing take place, that's a sign that the traders in here are junior traders. You know, more senior traders, they don't even know where halfback is, nor do they care. But that's it's a good daytime frame reference. It's a good time frame reference. So when you come down, but I'm talking about it's a smaller reference rather than larger.
You mean the overnight halfback?
The overnight halfback, the daily halfback. I mean, those are daytime frame references. But this came down exactly to the halfback in the overnight market, and it stopped right there. That is a very mechanical trade. Whoever was buying there, it's a shorter term trader.
Yes. Okay. Thank you, Jim. In terms of the volume POC and the TPO construction, point of control. We have some questions there. Some are saying double distribution, volume POC is here. Jim doesn't get that mechanical about it. He does use the TPO point of control that incorporates the time element. And obviously we're looking at volume right now, but we're using the volume at price here more as, look at, you got 12,000 and 12,000. That's a lot of volume there. Is it going to bounce off of it, or are they going to pull it over on them if those are longs in the market and break them and push it back through there? It looks like it's finding support there. That's how Jim would use volume inside the day. We are looking at volume, but not necessarily as analysis at the end of the day as a volume point of control. Jim is, like he said, pretty much a purist with his TPO construction and using structure from the letter prints and not volume.
Yeah, the problem, Julia phrased it perfectly some time back. People want to get almost in fights over volume POC or TPO POC, and as I say that, and she said, why? It doesn't have to be one or the other. The reason I focus on the TPO is because it includes time, price, and volume. The volume TPO does not include price, and price regulates all opportunities. So anything that price advertises opportunity, volume measures success or failure of the advertised opportunity. Time regulates all opportunities, and volume measures the success or failure. So I really like to look at a combination of all of those. Okay.
And we're seeing here, though, Jim, that the volume is supporting the market. I mean, it's tried to press lower toward those 12,000 prints we mentioned. They printed more volume higher. So the volume is a wonderful tool to use as a daytime frame trader reference. They're dynamic. They develop, these volume references develop. You can see how it's supporting the market, but clearly it doesn't mean that it's going to go up. The market can pull it back down. Again, this confidence is low. It hasn't made up its mind yet. But go ahead, Jim.
Mechanically, the halfback level and failure to fill the early gap, those were daytime frame buys if you wanted to do them. Like I said, they're not my trades. I don't have enough confidence in here. But if you want to go with the trend, and there's nothing wrong to say, okay, I'm going to trade with the trend. I'm going to buy on an attempt to fill the gap, and it gave you a mechanical reference, which is the halfback overnight and just a couple of ticks off of the 2-day high. And this is why I pointed this out at the time, that if you wanted to buy, I said it's not my trade, but if you wanted to buy, that was a legitimate place to buy down there. Now, Julia talked about this volume. If we start trading down below this volume, people that were buying here to take this market back up got to be very careful, because it can pull all this volume over on itself. So people that were buying this break, you start trading back down below the 12,000 contracts here, and all of a sudden that buying can be turned to selling, as that those short-term buys early on are forced to liquidate later on. Overnight inventory has restrained the market advance so far, but it hasn't corrected. But it has put a cap on the market early on. Overnight inventory is a very, very important observation for short-term traders. Overnight inventory remains long.
And yes, you don't see the adjustment yet. We're seeing some pressure of the overnight longs. They'd love to squeeze them out or play the game. They haven't been able to fill the gap. But you, in your estimation, Jim, don't feel like the overnight inventory is adjusted?
No, it's capped. It's capped the early advance. At least from what I see, it is capped the early advance. I mean, because some of the overnight people, every time the market sticks its head up a little bit, they take a little bit of profit. But there hasn't been any wide selling of that. So now we're coming up. We've got 10 minutes. We've got a couple of numbers. The numbers may be more important because this market is relatively quiet. But like I say, I think the big number today is going to be the beige book that comes out this afternoon. And the beige book, sometimes it's important, sometimes it's not. The beige book really incorporates the reports from the different Federal Reserve districts. What kind of economic activity and labor activity do they see in each of those districts? So it gives the analysts a little more detailed look of what is going on in separate parts of the country, and it's usually a relatively important short-term reference. Mm-hmm. You know, it can add volatility on a short-term basis.
Yeah. Okay. Thank you, Jim.
Okay. What are the questions we got? So far it's pretty quiet out here this morning.
Jim, am I right that when you use the term time regulates, that it means that the longer it stays there, the more acceptance? Because I used to think they were not getting follow-through, you know, when something stays there, so I would, would reverse. But it also could mean that there's more acceptance.
Well, when if the market goes down and it comes out of a low pretty quickly, I mean, it was quickly rejected. So it was very quickly rejected. Time regulated opportunity, and it was there for a very short period of time. Part of the trickiness is if that time, so initially, time is an indicator that you may want to buy if it's kicked out of there. But then, as time goes on and there's no upside follow-through, time can turn against you because now they bought it down there, but there's no real follow-through. So the longer it goes without upside follow-through, those that bought it down there, they start to feel the pressure of being long without getting much reward. So time is not something the easy thing is when you get kicked out very quickly, leaving a buying or selling tail. That's the easiest way to use time. But it's much more of a science and much more important when you get to a level and it can't take it out, but it just sits there. And then all of a sudden, if it doesn't lift, then be careful. And remember, it's a continuous two-way auction process. But let's go back and look at yesterday's high. There was the high in A period. C period high is just a couple ticks below it. D period high, just one tick below it. It left no selling tail. So did it get rejected here? Yes. But wasn't rejected aggressively. And as you can see, we came back and took that out fairly easily overnight because it really wasn't a very good high. Okay, the market is down one more time, attempting to fill the gap. And you're down low. You're down below this volume. Remember, you also are right at the half-back level from the overnight. Again, it's a very mechanical, short-term trader's reference. And right now, they're still using it. My guess would be that if we trade below this level, below half-back, then all of a sudden you get another little burst to the downside because, oh, it's below half-back, and they sell it.
And it was the early morning down there, so there's stops where people got long. But we saw the volume build, and people were asking, it just came on the screen while you were talking, can we sell at half back? And obviously you've got a great reference if you can get out a few ticks higher if it starts to give way to the upside, but why not? I mean, if you want to get in a trade and you feel like it's weak, that's a great trade location relative to today's range. Right, Jim? I mean, why not? If it's going to hold, as long as it's a tight stop, if they want to engage it.
It's a personal preference. There's nothing. I have seen nothing that I wanted to do so far this morning. But again, I've reached that level where I'm very pleased to pass on a trade because there will be clearer opportunities sometime before the day is over. Now we've got 5 minutes. We've got a couple of reports due out, and we've got about 5 minutes to go.
What do you need to happen to see this selling?
Well, I need to see volume, and I need to see that we can get well back within the 2-day range. I mean, right now we're getting some selling, probably the overnight inventory, but we're not getting. Remember, if there was any real selling in here. They've did this chance to sell at all-time highs this morning, and nobody's taking advantage of it. You're getting liquidation. The trickiest stuff, you're getting the liquidation from overnight inventory. You're putting more pressure on these folks. Questions?
Yes. Do you still pay attention to initial balance as you wrote about in Mind Over Markets, which would be the first two 30-minute periods?
Not really. I mean, I don't do it mechanically. I don't pay attention to the initial balance per se, but I'm always recording and I'm internalized, is the initial base narrow or wide in there? And the wider the base, the harder it's going to be to knock it over. The narrower the base, the easier it's going to be to knock it over. So I'm always thinking in those terms. Do I have a wide base? Do I have a narrow base? Okay. We're going to change time periods in 3 minutes. It's very hard. It's going to be very hard to get unchanged value today. You're going to have to get unchanged value. You're going to have to pretty quickly get down below the 2-day high and really start to show some extension to the downside. So far, all I've seen this morning is some liquidation of overnight inventory. Some people are selling just because it's high, but I don't see any indication whatsoever that I have anything other than short-term selling this morning. This last break took the market to a single tick below Halfback on the overnight market. It did not fill the gap. As we said earlier, it still was a potential buy with a stop if the gap is filled. And again, I have seen nothing that I wanted to do this morning. And I understand that I bet there's people out there that have traded 3 and 4 times already this morning. And sometimes I just say, you know what? It's kind of these markets have been very difficult, a lot of low volume, low confidence, and I just said, I just don't have to trade. I will wait until the trade becomes much clearer to me. Then somebody can say, well, Jim, but you always say go with any gap that's not filled. And that's legitimate. If you want to buy the gap this morning, like I said, when you come down on those early breaks, it's given you 2 opportunities, hasn't filled the gap. So if you had your stop down below, after the gap was filled, it hasn't been stopped out. It's a personal preference. But there's just nothing the way I trade that has told me this morning that, wow, I need to get in this market. I've got an opportunity building right now. There's nothing that's jumping out at me. They're trying. I wouldn't have been long early myself simply because of the overnight inventory. But I don't see any liquidation meaningful at that point. You've got 1 minute until the time changes and 1 minute until the reports. So those reports, there's nothing else going on. Those reports can add the volatility to the market.
And someone's asking, is there starting to be acceptance at these higher prices?
Oh, yes. Oh, yeah, no question. Okay, now, you do not have a good low. The reports are out. You do not have a good low.
Yes, and someone's noting that the volume at the lows here, is very low. It's still starting to, it's still printing. But it's not that boom, boom, boom where they just come in and start selling it. It's, sometimes the market has to go lower and check it out, make sure that it's secure before they take it higher. And overnight inventory, they love to squeeze them out too.
Well, the overnight inventory has restricted has restricted the market this morning.
On the upside.
On the upside, yeah. Okay, so now you've got a poor low from today. The market went down one more time, one tick short of the low. It bounced from exactly half back overnight. You do not have a secure low. In other words, there's no buying tail down there. So it's not high confidence low. I don't see any confidence in here at all. I see some very mechanical trading in here. I see a lot of back and forth in here, but it's the sellers have not been able to have their way with this market. I mean, well, they clearly could have, but the buying there's no serious buying in here. The market is still in a very very narrow range. Now, this range, the base of this range is very narrow. This, when somebody asks about initial balance, so the initial range in here is very narrow, and that can be that just tells us that there's a lot of churning going back and forth here, but there's no real conviction in here whatsoever that I can see. It went up to, the market went up to one tick below half back, and they were a little selling there. So we basically have a poor high in B period, we have a poor low in B period. Very low confidence.
A poor high in B period? What do you say?
Yeah.
You mean because it went to half back and just
because it went yes, good question. One tick below half back. Very mechanical high. It was just somebody selling because it was at half back. And 52 cars.
Yes. Yep. And we know too, when you talk about a narrow initial balance range, just in terms of initial balance or the first hour, we know you wrote it in Mind Over Markets a long time ago that the high or the low is often made in the first 30 minutes or 60 minutes of a session, so it can help us visualize what may be coming. It's always important to be looking out and seeing what could be transpiring, and keeping that in the back of your mind, it can be helpful. I mean, I don't think we're there yet on the, it's early to say that yet today because of the confidence.
Notice yesterday you had a poor low, HI period low yesterday. And again, it's a trading market. You now have a poor low today. You now have two back-to-back poor lows. And what I said, that's an exponential indicator. In other words, if one poor low is a -5, we don't do it that way. Two poor lows back-to-back wouldn't be -5 plus -5, which would be -10. It would be -5 plus two back-to-back lows. It's an exponential effect. So the second back-to-back low is like -30 or something like that. The two when you see two back-to-back poor lows, that's an indication that the longer-term money isn't interested on the buy side in here. The longer-term money in here is more than likely staying out.
Can you talk about the opening range, Jim? I've seen people use time based on the opening ranges and, things with volume and tick charts. The pit calls the opening range when all the market, open orders are filled. Do you use anything like this?
No, I don't. No, I don't. I just, I look to see, are we back and forth through the opening? Like today, we really haven't been back and forth to the opening. Open went a little higher, and it's traded lower ever since. But they've gotten very little on the downside. But at the same time, you don't have a good low today. You don't have a good low. You have two back-to-back poor lows. I don't know why I sit here and feel apologetic. I mean, I can't do anything about the market, and I shouldn't feel this way. I always like, well, let's have some activity. We're doing a webinar. But as I look at it, it would be difficult for me to be on the long side with two back-to-back poor lows. It's just not a particularly good indication that I had any aggressiveness on the buy side. What I've had on the buy side has more than likely been, you know, short-term, short day time frame and short-term money.
And we're 3 ticks from a gap fill. And the volume, Jim, today, just so you know, someone gave it to put it in 354 million, 1,000 contracts
On the
as
first
of 10
hour.
a.m. on the first half hour.
So that's, you know, that's low, not as low as we've seen some days.
Can you explain, Jim, why you use the pit high versus the settle to measure your gap? You know, many people use prior's pit session settle to measure a gap. You use the high of the range from the prior day. Can you explain why you do that?
It's just, I'm talking about it, it's just a thing that's really out of balance relative to the previous day. That's what I'm looking at. I look for something out of balance relative to the previous day. And if I get above or below the previous day's high or low, I'm out of balance. The settle is more of a random number. A lot of times it's just people trying to even up, you know, as we get close to the close. So I just don't. It's just not something. I'm looking for something meaningfully out of balance, not just a not minor. I want something that's fairly meaningful.
Jim, the Globex Low was made in the overnight, and there was a lot of news with the airline crash on the Ukraine border and all, but it came in the Globex Low at 1890, I think 75, cleaned up a lot of mess in structure, but it was overnight. Do you find, I'm talking, you don't have to move your profiles back there. The question is, how do you use that information with the Globex Low on this swing low from the all-time highs before it gunned for the all-time highs again? Do you feel like the market is going back there because the low was made in the Globex?
It's not clear in my head. I'm sorry.
Well, in the last correction, the low was made in the overnight session at 1890.25. How significant is this? Does Jim expect that we will revisit this sometime?
Well, sure, I record it. But, you know, once it goes through it, I don't worry about it.
What do you mean once it goes through it? You mean once it bounces off of it? Or
we rallied there. And, yes, if we go back there, I'll focus on it. But right now, it's not something that is that I'm focused on.
So that's not weighing on your long-term analysis that we need to go back. You just want to deal with the shorter-term references here and the all-time highs.
I really try to take it a day at a time. I'm very much aware that was the first time down below, I believe it was the 1900 level, and it bounced. It came in the overnight. The market had got just unbelievably short. If we start to go back down there, then all of a sudden, and I guess the best way to respond to that question is it's information to carry forward. And when I say it's information to carry forward, that is my way of saying it's not information that I'm using right now. But as I say, it's information to carry forward. If I start back down towards that low, then I will focus on it. I will bring it back into view very seriously and basically recycle it because, okay, now we're heading back down. It would be the second time down to the 1900 level. I know that the low was made in the Globex market, and then I would recycle it and bring it back into play. But for right now, we're clearly above it. And if I focus too hard on things like that, doing short-term and day time frame trades, it will give me cognitive dissonance.
Okay, thank you, Jim.
I hear there's somebody expressing their opinion at your house, Julia.
Yeah, she wants in. She's not coming. Tough love.
Okay, well, the market, go ahead, you have a question?
No, go ahead.
No, go ahead.
No, just someone was asking, he's been in, the intensive and wondering, he hasn't heard the overnight halfback mentioned too often, but when there's nothing else going on, there's no directional conviction, no confidence, they can lean on that. It's something they can lean on because there's no bias.
Absolutely perfect response. Yeah, you're right. I don't normally look at it, but when there's nothing else going on, short-term traders will take anything. You and I can see it here. We know where it is. They'll know where it is. So anything, markets tend to be very visual. In other words, references that they can see are much more comforting than non-visual reference. A non-visual reference would be, a Fibonacci number or, something that doesn't show up on a chart or on a profile. Okay, now, from a personal standpoint, and I'm not recommending anybody else do this. Okay, I just bought some puts. And why did I do that? And number one, it's a child's portion. I did it on this little rally back. And it's because I have two bad lows, two poor back-to-back lows. Was it a trade I'd do in any size? No. Is it worth taking a look at? To me, I decided that it was, just because of the two back-to-back poor lows. Now, a lot of people could argue to say, Jim, I don't understand that trade because you've got the gap. You didn't fill the gap. Don't you want to be long? And that may be absolutely right. I'm only telling you just because that's what I did because of the poor load. But again, it was a child's portion. I'm not married to it or anything else. It's just I'm just questioning if the low is going to turn out to be any good as we go through the day.
Right.
We're clearly back up to half back. We're clearly back to half back. If they get through half back, they can easily go for the high. The next reference on the upside, you get above half back, the next reference becomes the opening. Followed that would be the early morning high. Following that would be the overnight high.
Jim, yes, this is a question. We have one about the low, poor low, but as far as the poor high, we gapped higher. Is that considered that we've repaired the poor high from yesterday?
Oh, yes, absolutely.
Yes, just think of it as single prints fill too, because it's, it's repaired, it revisited it, think of the gap as single prints. As far as the yesterday's low, Jim, did you expect, what is Jim's analysis of yesterday's HNI poor low? Did Jim expect the buying tail, the buying that followed the poor low? Did you expect that yesterday?
Well, I was driving yesterday.
But it was interesting how it couldn't even take out the pit low from the prior day. If you
right.
have, it couldn't even get there.
Didn't take out Friday's low. More than likely, what happened is the market got too short. Remember, poor lows and poor highs are very often an indication that a market has gotten too long or too short. So if you have a poor high, very often it's an indication of a market that's gotten too long. A poor low, very much of an indication the market's gotten too short. So if you take yesterday, you had a poor high and a poor low, so it probably got too short, because you had the poor high. There wasn't any real aggressive selling up here. So this probably got too short right around Friday's low. And then when there's nothing else going, and sometimes there's nothing else going on. It was the first day back. It's unlikely that the more senior traders and money managers, a lot of times they don't wander back in until, later this week or next week. And, in the first day, they're not that anxious to come in and trade the first day back. After they've been back 2 or 3 days, or a week, then all of a sudden they take a little more serious look at what they've got for their portfolio. September overall doesn't usually appear to be a particularly good month. In the markets, traders kind of have a tendency to come back from vacation and reassess. But you don't want to spend much high time on that. I mean, you hear people say, sell in May and go away, and that's broken a few people the last couple of years. So I'm just talking a little bit of the market's been up. The market's been up for the year. It was up last month. It's not uncommon for traders to come back, and I'm talking about money managers, to come back from vacation and start to think maybe they should take a little off the table. But again, the main thing in here this morning, there is no confidence in here this morning. There's no selling. You've got to be very careful. There's no indication. You could get short-term selling and short-term liquidation, but you have no indication that the longer-term money came in and said, wow, here's a chance to sell at all-time highs. I'm going to do it. You're what, 45 minutes into the day, and that hasn't happened. Again, very, very low confidence. Julia, let me go to you got a question before I go to the slides?
People are asking about we have a few questions. First, Jim, people are asking about your put purchase. First, what is the time frame? And second, why not sell futures? The bottom line is this is what Jim does. He hedges. So he buys the puts when their market popped a little at halfback, gets a good price on the puts. Then when the market rallies, he can sell against them, or use them.
No, when the market breaks. When the market breaks. When the market
I'm
breaks,
sorry.
When the market breaks, I can either sell the puts or I can go take longs against the puts. It just gives me a little bit more of
you can just unload them, rather than an outright future. I'm sorry, of course, when the market breaks, he can buy against them, and it acts as a stop. I mean, or take them off, depending on what you see.
Okay. For example, the ideal thing would be what would cause me to go long. We take out the morning low, we pop on, we fill the gap, and there's no downside follow-through. I say, oh, okay, thank you very much. I may go long. Or if there's anything on the downside this morning, you should get a double I think on a day like this, you should get a double distribution day. If there's anything on the downside, you should break away and establish a whole new distribution down here. But basically, the only reason I did the trade was I don't like the market, but I'm not going to be an idiot. But the two back-to-back poor lows said, okay, that's worth a shot. They're 2,000 puts. They expire on Friday. So again, and like I say, it was a child's portion, very small trade. Okay, let me go. Here I want to cover these comments. These are unsolicited.
Can you put it on? It's too small. Put it on slideshow.
Okay, how's that?
Better.
Okay. These past 5 weeks have opened my eyes. You have my gratitude. I now have greater market understanding, greater self-awareness, and greater confidence. I never would have guessed this to be a self-improvement program. Discovering and contemplating my weaknesses and strengths on a daily basis with the high emotion that I attach to peak performance has been life-changing. Eric, thank you very much. And it really is what we're trying to do when we do the intensives. We're trying to understand the market from the point of view of the behavior of the people that we are competing against. And what happens so many times when you start thinking in terms of the behavior of the people you're competing against, you start reflecting more and more on your own behavior. And if you think about it, probably no more than 3 to 5% of the people that day trade make money. If you do what every other day trader is doing, your chances of being successful are pretty slim. So you got to understand when they get too long, understand when they get too short, and you're actually playing against those emotions. When they get get overexcited on the upside or overexcited on the downside, the tendency is for, if you're not careful, is to go with them because, boy, it looks like it's going down or it looks like it's going up. As you start to understand the emotional level of trading and what they're doing, sometimes it's very helpful to say, wait a minute, I don't want to get caught in that. Now, let's just stop for a second. Okay, so we now have gone down and mechanically filled the gap. We filled that gap down there. Now the question, this is the really difficult question. If there's anything on the downside, we should get a double distribution day. In other words, we should get back into yesterday's range and we should start to extend to the downside. And it's a little early.
The single prints from the B period. We should come back to the double prints up there.
And hold those single prints. And so far, it's certainly not very convincing so far. So hold on just one second, if you will.
Jim, we have a comment. We only traded one tick above the open and were unable to trade through the open again. Leaving this point out of the discussion, it's just a problem, for day traders. He's saying it's an egregious error, but I mean, do you have any comment on that?
I'm not sure what.
Just not coming back up to the open and trading through it.
Yeah, well, yeah, I still think it was some pressure from the overnight, but it's a legitimate. When you come back to it's a legitimate short. When you can't get back there, and you say, okay, what do you need for downside continuation? You need not to come back there. You need to, you get back, fill the gap, and get acceptance down there. So, what happens sometimes after the site, you look at it and say, well, I should have gone short there. Well, I can see that after the fact. The market was very quiet this morning, and like I say, I finally decided to do a trade because of the two back-to-back poor lows. Now, just a minute ago, I said, excuse me for a second, and what I did is I bought some futures against my puts. And the reason I did that is I'm not feeling the conviction. I'm in pretty good shape now because I got lucky on the purchase of the puts. And,
were those 2,000 strikes, Jim?
They were 2,000 strikes. They expire on Friday. And, and now I have, now I've just bought, I bought 40%
futures against the puts.
I'm sorry, about 35% futures against the puts. So at this point in time, all I want to do, I just want to see it, move either up or down pretty sharply.
So people, okay, and we filled the gap. Not much conviction. Value is higher. Can we start to, can we think about getting long?
Well, I don't know. I don't jump to that. I mean, what am I saying right now? If there's anything on the downside, you keep the double distribution. So your trade right now is to the short side. With your stop probably right there where the AB, probably at the 205 level. Your trade right now is to the downside. You filled the gap, and if there's anything to the downside, you probably will not trade back to the 205 level, which is where the early morning low at the AB level was.
We had a question here was, can we say the sellers cannot conquer yesterday's high? This is before we filled the gap, and buyers want better prices. And now he's asking, as we filled the gap, do we say that buyers want better prices before they'll get involved?
I think you can overthink it. I mean, I understand what you're saying. So you're looking for where do the responsive buyers come in. But I think what happened here this morning is you had a very low confidence market. Remember, overnight inventory was 100% long. And we said that's about 65% of the time that we get a counter auction relative to that overnight inventory. So as the day went on, and you didn't get the bounce, that puts more and more pressure on the overnight inventory, on those people holding overnight positions. The longer that goes on and they don't get out of that position, and the market, the market doesn't lift, the greater the odds that all of a sudden those people are going to hit the panic button and start to liquidate that inventory. I think that's what went on this morning, and I think that liquidation is still underway in here. Okay, now the question becomes, you filled the gap. The question becomes now, how does value, what happens to value? We're right at the top of yesterday's value, so as time goes on, you have to get accepted down below the top of yesterday's value at the 202 level. What is it, 202.75? And if you don't, then all you got was some liquidation. All you got was some liquidation from the overnight inventory. Once the overnight inventory is corrected, then the market begins to rotate higher. Additional questions or comments, Julia?
Hi, Jim. When you say that you're hedging by 30 to 40%, are you using delta to determine the percentage?
No, it's nothing that sophisticated. I just look at it. For example, if I had 10 puts, 3 futures would be 30%, 4 futures would be 40%. It's not. I'm not a scientific person. I don't use the deltas per se. It's more, and this is why I hate talking about and doing option seminars, because I don't do it scientifically based upon deltas and all the Greek numbers, etc. I basically looking and say, what do I think's going on in this market? And so some of it's just kind of a Kentucky windage. Sorry. I know that's not a pretty good answer, but I can look and I can pretty quickly calculate. Okay, here's what my puts cost me. Here's what I've got in them, and what keeps me break even. What gives me a nice profit? And I said, okay, what I really need is I need a pretty good move up or down to make it really attractive, but I'm pretty well break even unless it just goes to yesterday's high and stops. Okay, let me go back. So we did fill that.
Okay.
Go ahead. I'm sorry. Go ahead. I'm sorry.
No, but before you go back, I mean, until we see, usually we'll see some type of exhaustion before this is done. Traders are looking, values higher. They're looking to, situate or position themselves perhaps on the upside with good trade location. But clearly, until this gets some exhaustion and volume comes in to stop it or turn it, you wouldn't be looking to get, I mean, you're long, but you have puts on the other side, so it's a different time frame.
Mine's totally different. It's not a different time frame, it's just a different risk parameter.
Well,
I mean,
just different risk, thank you.
I basically locked in some profit from the puts. I'm sitting there saying that I didn't pay much for the puts because they expire Friday and they were out of the money when I bought them. But I'm sitting there saying that this market has a pretty good shot that it's going to go, higher later on, and if it does that, I just want to have the futures, because there's not a lot of conviction on the downside here this morning. As I said early on, if there's any long-term selling, they could have been in there early and been selling this market at all-time highs, and nobody was doing that. I think all we've seen this morning is some liquidation. I think all we've seen this morning is some liquidation of overnight inventory, and that's why you're doing the short-term trading. Understanding overnight inventory is very important. And then as that process was going on, when I saw the second poor low back-to-back, I'm saying, who buys exactly at the early morning low? That's not long-term money. That's short-term or day time frame money. And I said, okay, well, thank you very much. I thought that was a piece of information, allow me to make a short-term trade. 2 back-to-back poor lows. I've talked about that numerous times, that's an exponential type of thing. It was simply a risk-reward. Now, it was hard to explain to people because I said, well, Jim, you know, why would the gap hasn't been filled, why would you be going long rather than short? They're short-term trades, and you know, it's just the circumstances. So when I talk about understanding markets in terms of the behavior of the people we are competing against, what I thought I saw this morning was no long-term selling at all. I saw overnight inventory was 100% long. You saw that in the report. Anybody that's been with us has heard that on numerous occasions. And we already know that 65% of the time we correct overnight inventory. And it doesn't have to be a full correction. Early on we said the overnight long inventory was probably restricting early morning advance. And then finally I think it just kind of weighed in, and you got the liquidation that the overnights finally gave up and began to liquidate. Okay, let me go back over here.
Jim, who's in pain right now? You know, when you ask the question, who's in pain? It's obviously the overnight longs or the early pit.
Overnight longs that haven't gotten out are the ones that are still in pain.
Or pit session, the early morning pit session longs when we saw that volume that are hanging in.
Those that were buying exactly on the low this morning, those that were buying the early morning low kind of mechanically. We saw that you pointed out where that volume was, and you know, you kind of took that as supportive. I looked at that volume and I thought, well, yeah, it looked to me like it was weaker volume because there was no real follow-through to it. It got my attention early on, but when it couldn't get back above half back, I mean, it just mechanically there, it said be careful, it gets pulled over in itself, which is what happened. Okay, so but the people in pain right now are the early morning longs, the people that were blindly going long in the overnight longs. Okay, this first comment by Eric S. is very important because so many times people enter into the intensive thinking that, you know, what they really want, what they think they want is where do I buy, and where do I sell? And that is, well, yeah, you have to execute at some point in time, but it's far more important to get a base, a foundation, and understanding yourself, understanding the market, getting a greater understanding of market understanding, getting a greater understanding of self-understanding, and understanding the behavior of the people you are competing against. I mean, I've played a lot of athletics over the years, a lot of racquetball, and now I'm playing pickleball, and I'll tell you, an awful lot of what goes on is you're constantly sizing up the people that you are competing against. And an awful lot of the decisions you make are based upon who you're competing against. And rather than doing the same thing every time, you know, and trying to do it mechanically. And that's why it's so important. And when Julia came up with the idea of the intensive, you know, when we go to and do a seminar in a hotel or something like that, you know, we get good remarks. Julie, good reviews. Julia takes good care of the folks, answers questions, sees to their needs. I sing and dance on the stage, and everybody thinks, boy, didn't they do a great job? But the truth of the matter is, over a 3 to 5 day period, one, if you don't get enough of the right kind of markets, it's going to be very difficult to really get the experience you need. And secondly, it's very hard to internalize all the information that's important that quickly. So the intensive spread out over a 30-day period increases the odds that we'll see better markets, or I mean different kind of markets. And it also gives us a much better opportunity to begin to understand ourselves in there and internalize the information that we've seen. Now the next comment down here is, now that I've had time to digest and put into practice the material presented, I find that I am making fewer trades per day and, surprising enough to me, more profit. Ron W. The strongest comment that we get from people, and it usually doesn't come from people that are attending their first intensive. It usually takes the having been through the tape sets, reading the books, and an intensive or two, that people start to understand this idea that the less I trade, the better. Most people overtrade. Most people are too impulsive, and they want to trade too early. And when you start to get to the point, as Julia said earlier, we're talking about trader maturity. I think that's on the next slide. When you can pass on a trade because it really doesn't fit what you want, and you say I think it's going down, but it's not my trade, I'm passing, you really are starting to become a very mature trader. You're trading on your terms, not on someone else's terms. And when you trade on your terms, you are in such a much stronger position. Because I always chuckle at, as I say, my daddy said, never bet another man's game. Well, he was a very poor gambler, so he should have listened to that. But there's an awful lot of truth to that. You're going to trade, I want to play my game. And that doesn't mean I can't control the markets, but I can control what opportunities I'm looking for. And let's go back. You saw that a little bit this morning. I brought the markets back up. I didn't particularly like the market, but I saw a trade that interests me, the two bad back-to-back lows. Once the gap was filled, I didn't feel that there was any real selling. I said, I think there's probably a pretty good chance this market rallies in here. Or, I said, well, so if I really thought it was going to crater, I wouldn't have hedged the puts. I'd have just sold them or left them. I thought, well, the conviction isn't here. So I'll take the short odds play. I'll just hedge up my puts a little bit. So they're not going to hurt me. I still have a good
You'll buy
opportunity.
outrights, you mean? You'll buy futures on your puts.
I buy futures against the puts. But, if I thought it was really a weak market, then I wouldn't. But I didn't see that weakness. I thought I had some liquidation from overnight trade. So I'm trading my game. I'm trading on my terms, not anyone else's. And that is the kind of thing, when you get to that level, you really start to master the markets. And the big thing is to trade on your terms. But we find consistently that the people that bring down the number of trades that they do have the greatest odds of becoming profitable. And I can't tell you how many times that has come back to me. Following the last intensive, I got the most positive comments based on that I've ever received as long as I have been talking about trading. And sometimes people were just amazed. I know the one trader in here, I remember him years ago sitting at a conference we did at Napa. He had off the crude floor, NYMEX floor, and you could see his figures constantly buying and selling. And, and he wasn't being successful, but he felt like a trader. And as
well, that's what he knew, too, as a floor trader.
Yeah, that's right. And as it went down, first he reported, I think he brought his commissions down by 60%. Now he's trading on his own. He lives at home. He supports his family, and does less and less trades. And as this quote says, I find that making fewer trades per day and slicing me more profit. Remember, there's two risks in trading. There's a financial risk and there's a psychological risk. If you trade too much, you usually expend your psychological capital. And once you expend your psychological capital, it's very difficult to make the correct trades in there.
We hear floor traders say that they're paid, they have to change their paradigm, that they're paid not to trade today, as opposed to being on the floor, low commissions, really in touch with everything. So they're paid, to just sit tight.
Very few ex-floor traders are able to make it trading electronically because it's a totally different game. You would think that they would have an advantage, but sometimes it's a disadvantage. So the level of success coming off the floors is very, very low. It's frightening, the number of broken homes and marriages and sometimes even suicide. Some people that, were successful on a floor and can't make the transition to electronic trading off a screen. It's a totally different ball game. Okay, but here you see again, when you can pass on a trade and you don't feel the need to have to trade all the time, you become comfortable yourself, you're reaching trader maturity. Very, very important consideration to make. Okay, the fall intensive's coming up. It includes 8 hours per week. I do live narration, and as I think almost always we have added more hours of live trading. Throughout the day, there's a dialogue where it's a one-way chat that I'm putting out comments throughout the day. The intensive before, I wasn't there all day. When I was there, I would do it. The last intensive, I was there all day unless I had a doctor's appointment or something. And the following intensives, I will be there all day making chat comments throughout the day. Like I say, it's one way, but it's very important because it's as close as you get to having, one-on-one mentoring, which is prohibitively expensive for most people. Upon enrollment, you start receiving the 2 daily reports. We do a recap and preparation report every evening, and then we do an update in the morning. And upon enrollment, you gain full access to the over 100 trading articles and over 50 webinars. That is just great, great background. Julia, your lips are moving, you're breathing. That means you have a question or a comment.
No, that's great, Jim. Can you go back to the markets? We have a couple of questions. The overnight high being, still hanging out up there. How does that factor into your market perspective, for the day?
Well, it factored in early to saying it's very, the odds are very low that was the all-time high. Doesn't mean it's not today's high. I pointed out in the report that, the market made a high on December 31st in a holiday atmosphere, and that high, it was an electronic high following December 31st, and that high wasn't taken out until the 24th of February, but it was taken out. But so I factor it in. But more important, what I factor in more than anything is that early this morning, overnight inventory was long. Factor one. 65% of the time or so, we see a correction. Next, I said, okay, if there was if long-term money really wanted to sell, guess what? They could have sold at all-time pit session highs this morning to their heart's content. They weren't there. They weren't interested. So I think all we got was just some liquidation of overnight inventory, and once that was over, the market's trying to trade higher. And where is it right now? It's back to halfway. All trends are up. The market had a chance this morning, didn't do anything. It closed the gap, and we said if the gap is closed and value isn't going to be unchanged or totally overlapping yesterday, the chances of a later rally are pretty good. The market went down exactly to yesterday's value area high, which is not comforting to me. That's usually a sign of very mechanical trading. It's a very visual reference that more and more traders are knowing, are aware of. And I think that's all we've got going on this morning. The problem, sometimes traders try to make more out of a market than exists. Like I said, at one point in time, I was almost feeling apologetic that the market was so slow. I'm doing a webinar, and the market's so slow, I want more. And I'm sitting there saying, what a silly thing to feel. What a silly thing to feel. I mean, the market is what it is. There's nothing going on. And like I say, the one piece of information, and sequencing, we use the word sequencing a lot. And it's a word that it just entered in the last couple of months that we started using it. You know, if you would have asked me early on, what do I think? I think value is going to be higher today. And you would say, well, why did you buy puts? Well, it's a sequence. It's the sequencing was once I saw the two back-to-back poor lows, I thought I had a pretty good chance to get more liquidation from the overnight inventory. And once I got that inventory, once I got that liquidation, then I could decide, you know, what I might want to do again. So it was the sequencing of what came first. I said, well, if I watched it for a long time. I finally identified something that interested me, and I said, well, I think the sequence probably is, you know, we get a little bit, a test to the downside, a little more liquidation, and then we probably come back up. You know, again, I don't know what's going to happen before the day is over, but this idea, it's so difficult being a short-term day trader short-term because sequencing is extremely important. You know, these little short-term moves that go on in the marketplace. Okay. So anyhow, the other thing is, as soon as you sign up for the intensive, you start to get the daily reports in there. So there's other packages, as you will see, for people that are new to us. There's other packages that include, you know, one or two of the videos and the intensives. So there's other ways to get knowledgeable on this information. But if you are new to us, again, we are, I don't particularly like the word, but we're really a total package. It's not a question of where you get in, where you get out. That's important. The execution is important. That's how you really make money, and the tactical side of it. But it's really this broad understanding of the market and really how the market works, the understanding of the market, understand the behavior of the people you're competing against, and then at the same time understanding your own behavior. How are you going to, you have to use the behavior of the people you're competing against to be profitable, but you also have to control your own behavior. Sometimes you want to go with them, sometimes you want to fade them, but you at least want to understand what they're doing and what their motivation is. Once you understand that, it gives you a really strong edge in trading the markets. Anyhow, we're way over our time, but that's okay. Any final questions, Julia?
Well, a couple of questions about the indices. How do you correlate the S&P with the NASDAQ? Early today, the NASDAQ had filled the gap before the S&P. You know, do you want to speak to that in terms of how you look at multiple, you know, the indexes?
I've been, you know, you could have taken snippets from any part of my career, and the answer would have been different. Basically now, I do not look at the other indices. I'm looking at this market. I'm looking at this market. Now, am I aware that we've had some pressure on the downside in the bonds the last couple of days? Am I aware that the dollar has been pretty strong? I am aware of that. But I really don't, I don't try and coordinate with other markets. There's so many things that keep you out of a trade. And you start looking, well, what the NASDAQ's doing, what's the S&P's, or what's the Russell doing. In most cases, give you more reasons not to do a trade than reasons to do a trade. Anybody, you know, traders know if you see the NASDAQ's down, it fills the gap first, and this hasn't, you know, follow this market. There's other people trading this market that already know that information. So it's nothing really new. It's really nothing new information. I just think you're going to be better off, if you're a short-term trader, I think you're better off to focus on the market that you're trading rather than running all over, looking at every other place for information on how to trade this market. I think it will mislead you. I mean, we had a period of time there where we had a huge correction in the Russell and in the NASDAQ. And the S&Ps and Dow kept going higher. I mean, you know, that stuff can do you more harm than good, I think. Look at this market. I didn't look at any other market this morning. I had a pretty good idea what's going on. Okay, another couple of questions.
When you say value is up, it's compared to yesterday's value area, correct? Not in terms of the current session. Because she's saying, and if I'm looking at just today, the value seems to be going lower. But you're referencing, just to be
No,
clear
no.
about how you
It's
assess
just
value.
to yesterday. It's always relative to yesterday. There's the high of yesterday's value area, 202.75. The low of today's value area so far is 204.50. So value, it's always value relative to yesterday.
And
Now, that doesn't mean that the market doesn't start to, extend lower and point of control migrate lower, and today's value starts to change, but not right now.
And Jim, people are asking the gap rules. It's, in the glossary there's a definition of the gap rule. It's really one rule. If the gap is filled and the value cannot become at least, similar to yesterday's value, the odds of a later day move in the direction of the gap are high.
That's what we're getting.
And that's what we're getting. So the gap rules are in play then, sir, correct? That's
absolutely. The gap was filled. The gap was filled. I was processing information. I was sequencing. I was processing information, and it looked like the gap would be filled. It didn't look like there was much odds that the market would do much on the downside. Simply because we went 45 minutes. Like I say, anybody could have sold at all-time highs, and nobody took advantage of it. Guess what? If they don't want to sell at all-time highs, where are we going? We're rotating back higher.
With the value, and that's why you took a long, about a handle lower than the high from yesterday, somewhere in there, 02, 75, 03. Okay. I think, in terms of the confidence, the slowness of the sell-off adds to your low confidence assessment for today's market, correct, Jim?
Yes.
And the correlation we got, okay.
Now notice,
Jim buys puts on the weekly S&P futures contract, so that's weekly puts. He bought Friday puts, weekly options that expire on Friday. Just to get that out there. Usually, I'm just saying on your put purchase this morning.
Yeah, usually that's usually what I do, and that's changed over the past year or two.
Used to do more monthly.
I used to do more monthly. It's a, don't automatically go to options. I mean, there's a lot of psychological negatives trading options. It adds a lot more complexity.
Yeah, first understand the fundamentals before you're passing behind your back. I mean, Jim was involved in the CBOE being formed. He's looked at options for decades. And, I mean, you used to go to dinner or lunch with the Black-Scholes model gentleman, right? So, I mean, this is something that is so internalized for most of us.
And believe me, I continue to make huge mistakes. And usually when I make a mistake, it's because you get a psychological comfort with options that really wasn't deserved. Okay, final question.
Would you say that we now have price acceptance above the 2,000? And, where would you take that from here? Finally, there was a little tug of war around 2,000, obviously. I shouldn't say little.
Well, we went down below it yesterday, but right now you're accepted above 2,000, but it's, it's not that far away. But, it's not that far away. Today's low is 2,275, so there's nothing clear. We're not really clear of that level just yet. This is just the second day back from summer vacation. Don't get too complacent just yet. Just stay with this market on a day-by-day basis. See what happens over the next few days as the longer-term traders and money managers settle back in. And don't forget, we've got the market's going to be quiet today. You've got the ECB tomorrow. There's going to be a lot of focus on. A lot of people are stepping on the sideline today because short-term traders, know the ECB is more than likely going to do something tomorrow. You've got ADP tomorrow. You've got the employment number on Friday. There's a lot of short-term, things expected to happen. Plus, this is September, and I think the Fed says they're going to do away with tapering in October. So, and people still don't know what's the result of that once the tapering is over. So there's a tremendous amount of uncertainty in this market. Almost all my trades are going to remain short-term right in here. All right. Thank you all very much. I'm glad we could go an extra half hour, and I really hope that a lot of you that haven't been to one of our intensives or those that have been and want to repeat, I hope you join us, and like I say, we will do our best to give you more than you ever expected in the intensive. So,
All right.
thank you.
Great. Thank you, Jim, very much. Thank you, everyone. We will get this recording posted to the site, and in about an hour it should be done. Okay, so thanks, everyone, for being here. Have a wonderful day, and our next webinar is next week. If you're on the email list, you'll be getting that. It's at our site under upcoming webinars. We have a webinar each week up until the end of September. Okay, thank you very much. Be well. Bye-bye.